wherein we're talking about capital budgeting and the different methods and techniques under capital budgeting. So we've seen the simpler techniques, right? The net present value method, and then we saw the payback period method, and we saw the accounting rate of return method as well. And in the previous session, we had started discussing about the internal rate of return method. I believe you would have watched the video. And when it comes to the internal rate of return method, the very important thing we should remember is that basically it follows the concept of the net present value method. So there is no separate formula when it comes to internal rate of return method. We're going to be using the net present value method itself, the formula. Remember the table and all, where we calculate the net present value of a project. We're using the same thing. Only difference is that instead of calculating the net present value once, we have to calculate it twice or thrice, because this it follows the trial and error concept. Okay, and here they're never going to give you the percentage. They're never going to tell you that this is the rate of return or this is the cost of the capital. Okay, if you look at the previous questions on net present value, you'll clearly see that they'll give you the cost of capital is 10%, cost of capital is 12%. Okay, however, here in case of internal rate of return method, they do not provide you with the interest rate or with the percentage. Rather, you have to assume a rate of return. Okay, you have to assume a cost of capital, a starting rate, and based on that, we have to adjust whether we'll increase the percentage or decrease the percentage. Okay, so in the previous session, I believe if you watched the video, you would have understood how to do it. But then just again, we'll just go through it once again and just see how to solve another problem. Right, so I have a very small problem here, and it's not going to be too complicated. This will show you how to calculate the IRR when there are two projects involved. Okay, so if you know how to calculate for one project, basically it's the same for the other project as well. Okay, so let's look at the question. A company has to select one of the following two projects. You have details, project A and project B, and first information is with regards to the cost. Okay, so for project A, the cost is 11,000, and for project B, the cost is 10,000. So by cost, it refers to the outflow of cash. Okay, please remember, cost is your outflow of cash. And after that, you have cash inflows for 4 years. For project A, 6,000, 2,000, 1,000, and 5,000. And for project B, we have 1,000, 1,000, 2,000, and 10,000. Now, using the internal rate of return method, suggest which method is going to be preferable. Okay, so, which project is going to be preferable. So here, once again, you'll notice there is no percentage given, correct? Whereas in case of NPV, they'll give you clearly the cost of capital is so much and so much. Here, there is no percentage given, and if clearly given, using internal rate of return method, suggest which project is preferable. Now, in the future, if you get questions wherein they don't give you a percentage and they don't mention which method to use, the moment you realize that there is no percentage, make sure you're following this internal rate of return method. Okay, remember, it's also called as your trial and error method. Okay, so let's start solving this problem now. Now, there are two ways in which we can start with the IRR problem solving. Okay, the first way is where we just blindly assume any percentage that you want, whatever percentage you're comfortable with. Okay, so this is one method. Now, another method is a more scientific and a more reliable. In fact, it makes calculations a little easier. So this other method is one in which we calculate a certain, when we calculate present value received annually for so many number of years, and then based on that, we use a table in order to see how much we're getting. Okay, so remember the tables that I provided you with. I will be providing you with the tables I'm using as well. Table 1, table 2, those same tables, right? So I'll be attaching those to the classrooms, for the classroom, for this particular day. So anyway, now one way to do is where we calculate firstly factors. So factor is equal to initial cost, which is capital I, divided by average cash flows. So we can write it average C. Okay, so basically this formula, we'll be writing it as F is equal to I divided by C, initial cost divided by average cash flows. Okay, so here I'll be writing I is equal to initial cost, whereas C is equal to average cash inflow. Outflow divided by inflow, basically. That's all what it means. Okay, so remember, also please notice here, I'm using the capital I and not a small letter I, because small letter I, we know already it is for interest rate. Okay, so this formula is applicable again to both of your projects. So let's calculate first for project A. Now in case of project A, factor F is equal to, oh yes, I forgot to mention, F is equal to factor. Now this factor is in fact nothing more than our the present value of rupee 1, present value of rupee 1 received for n years, received annually for n years, received annually for n years, right? Okay, so that is the meaning of the term factor. Okay, so moving on, for project A, factor is equal to I divided by C, which is equal to I, is your initial cost. So initial cost, or the cost of the project, in case of project A, if you look at the question, project A, the initial cost is rupees 11,000. And then when you have the average cost in case of project A, for the first year, we have cash inflow of rupees 6,000, second year rupees 2,000, third year rupees 1,000, and in the fourth year rupees 5,000. And since we said these are average cash flows, therefore divided by 4. Okay, so based on this, factor is equal to 11,000 divided by 3,500, which is equal to 3.14. Factor in this case is 3.14. Now I'll explain this as I go ahead. First, let me calculate the factor for the second project. Okay, so next I'll just calculate for project B. Right, so for project B, factor is equal to initial cost divided by average cash inflows. Initial cost is rupees 10,000 divided by average cash inflows is equal to 1,000 plus 1,000 plus 2,000 plus 10,000. Okay, so this again divided by 4 is equal to 10,000 divided by 3,000 is equal to 2.86. Okay, so these are the factors that we are having. Now we're going to use these values here, 3.14 for project A, whereas for project B, 2.86. And based on these two factors, we are going to measure, or we're going to figure out the percentage that we're going to be starting with, or remember, trial and error method, right? IRR is a trial and error method. So the first percentage that we are going to use in case of the in case of solving of the IRR. Right, so I just want you to look at the tables that you have. Now, the table number may change, appendix number and all may change, but this line here, look for this line in your tables. Present value of rupee 1 received annually for n years. Remember, we're calculating for present value, right? So that is why we're looking present value table. Now, it's because another reason why we're going through this table for n number of years is because we know how many years we have, and we just want to figure out after this, in this question, it is 4 years. Okay, so we just want to figure out after 4 years, when we are getting the inflow and the cash outflow, what is the total percentage that we are supposed to be getting, or what is the total rate or the factor that we're getting. Okay, so after 4 years, what is the rate total that we are getting? Okay, so the sum of the rates that we're getting. All right, so as we're saying, 3.14 for project A. Now, I want you to look, remember, n here, n is equal to 4 years. This is from the question itself. In the question, they've clearly mentioned you have 4 years, and this also is a factor for here. Okay, so n is equal to 4 years. Now, I want you to look at the table, years 1, 2, 3, 4. Okay, now that you are at year 4, let me just zoom in. Right, so we are at year 4, and the factor is 3.14. Look for a number that is closest to 3.14. Okay, so 3.5, 3.4, 3.3, 3.17, and 3.037. So these two, this is the closest, right? 3.17 is closest to 3.14, which means my IRR rate, I should start it at 10%. Okay, my IRR rate for project A, I'll start it at 10%. Now, the same way we can go for project B also. Now, in case of project B, it is 2.86. And again, n is equal to 4 years, right? N is equal to 4 years and factor is 2.86. So in the fourth year, look for 2.86 or something closer to 2.86. So 2.855, basically 2.86. and this is 15%, which means I'll be calculating my NPV at the rate of 15% for project B. Okay, so this is how I'm trying to get a number or get the percentage which is closest for me to start with. Again, you do not have to follow this. Okay, again, you do not have to go through the trouble of calculating the factor, because you can just assume whichever it is that you want. You can just assume a number. You can start with 10%, you can start with 12%, and then adjust along the way. Okay, so it's not necessary. This working note right here, remember, this is a working note. Okay, this is a working note. Now, this working note is not mandatory. Always remember that this is not mandatory. But, you know, if you're getting confused with what to start and all, then this is a good way to start. So besides this, we can just write a small conclusion for this. So we can just conclude it by saying, in case of project A, the rate comes to 10%, while in the case of project B, it comes to 15%. Okay, just write a conclusion of what you have calculated and what you got from here. Okay, so as we said earlier, the IRR method is nothing more than the net present value method, except we're doing it twice or thrice. Okay, so I have already prepared my table with regards to for project A. Let's have a look at the table. Just like how we're calculating NPV, correct? And here also computation of NPV at the rate of 10% discount factor, what we just got from the previous working note, right? 10%. That is why I'm starting with 10%. So here, cash inflows, present value factor at the rate of 10%, and present value of cash inflows, or as you know them, CFAT, present value factor, present value of CFATs. Okay, so this is nothing more. It's just what we have been doing for net present value method. Okay, so let's fill up what we know. Firstly, the year, first, second, third, and fourth year. And we also have the amount for cash inflows to be 6,000. For the second year, it is rupees 2,000. For the third year, rupees 1,000. And for the fourth year, rupees 5,000. Now, present value factor at the rate of 10%. Once again, the calculation of present value factor, 1 divided by 1 plus I to the power of n. 1 divided by 1 plus 0.10 to the power of 1. 1 divided by 1 plus 0.1 square for the second year. For the third year, 1 divided by 1 plus 0.1 cube. And for the fourth year, 1 divided by 1 plus 0.10 to the power of 4. I prefer doing it like this, like writing it in the table itself rather than, creating another working note, because why waste time or waste space? Okay, and again, it's always better to show the calculations as well. Okay, it's always better to show the calculations as well, so that the examiner knows that you were the person who actually calculated these. So just write it there along in the table itself. You have a lot of space. Okay, so for the present value factor at the rate of 10%, for the first year it is 0.909. For the second year, it amounts to rupees 0.826. Third year, 0.751, and for the fourth year, 0.683. So I'm moving rather fast because we've been doing this over and over again. Okay, so present value of cash inflows, present value of cash inflows. So PV into cash inflows, 0.909 into 6,000 should amount to rupees 5,454. For the second year, 2,000 into 0.826, 1,652. For the third year, 0.751 into 1,000, it is rupees 751. And then for the fourth year, 0.683 into rupees 5,000, it should come to rupees 3,415. Okay, and then after this, we generally close this table, right? We close it, and then after that, we calculate the net present value. So total should be 11,272, which is my net present value. Okay, net present value has amounted to rupees 11,272. Now, a very crucial thing here comes is you have to compare the net present value. Okay, you have to compare the net present value with the initial amount of investment. Okay, with the initial amount of investment. If there is, if there is a break-even point where there is zero profit, zero loss, then in that situation, we should accept the percentage. Okay, if you reach where in the cash inflow, All right, I'll just write it right here, okay? So if cash inflow is equal to cash outflow, then in that situation, it leads to break-even point, which means we should accept the rate. Okay, now in this situation, the present value of cash inflow is 11,272 and the initial cost or the initial investment is rupees 11,000. So more or less it is quite close to one another. So we can assume present value factor to be 10%. Okay, we can assume present value factor to be 10%. However, because it's a trial and error method and because there is no specific percentage, it's always better to calculate the the more accurate percentage. Okay, so let's just write a small conclusion for this as well. So in our conclusion, we can say that the present value at the rate of 10% comes to rupees 11,272 and the initial investment is rupees 11,000. Therefore, we may assume the IRR rate or the internal rate of return, to be 10% approximately. However, if we want more exactness, another trial rate should be taken. Now, if you look at the differences here, the initial investment is rupees 11,000, but the total present value comes to 11,272, which means present value here in this situation, present value is higher than our IRR value. I'll just write as IRR value. Okay, present value is higher than IRR value, which means we have to reduce it, right? In order for it to come down to 11,000, we have to reduce it from 11,272 to rupees 11,000. Okay, it has to come down. Now, at 10%, if it's this much, we have to now take percentage which is slightly higher in order to bring it down. Okay, I know it's a little bit confusing, but when it comes to IRR, if IRR is higher than the present value, then that means discount factor, next discount factor should also be higher. And the opposite applies in case the present value total is lesser than the IRR. Okay, for example, if you're getting another value, let's say if the initial investment is 11,000, you're getting it to be 9,000, then in that situation, we have to take a lower rate. The lower the rate, the higher will be your return. Basically, that's what it means. Okay, the lower the rate, the higher will be the return. Okay, because this depends upon the percentages. Every percentage at a higher rate of percentage, getting a lower kind of a return, so as to say. Okay, so basically this is just the concept of it. So which means we have to take one higher percentage. Now you can take it at 11%, you can take it at 12%, okay, whatever percentage you want to take it. In the tables, I think you have some 15%, so you can take that as well. Or, okay, I'll just take it at 12%, just to be on the safer side, I'll take it at 12%. Okay, though of course we are certain that it's somewhere around 10% itself, but let's just take it at 12% to be a little on the safer side. Okay, so everything else remains the same. Here, 1, 2, 3, 4. Cash inflows, again, same amount, 6,000, 2,000, 1,000, and 5,000. And then present value factor at the rate of 12%, 1 divided by 1 plus 0.12 to the power of 1, 1 divided by 1 plus 0.12 to the power of 2 for the second year, 1 divided by 1 plus 0.12 to the power of 3 for the third year, and for the fourth year, 1 divided by 1 plus 0.12 to the power of 4. So you can do the calculations. So present value factor at the rate of 12% for the first year should be 0.893. For the second year, it should be 0.797. For the third year, it should be 0.712. And for the fourth year, it should be 0.636. And then present value of cash inflows, present value into cash inflows. So I'll just write the totals here. Please make sure you're calculating just in case there are any calculation errors on my part as well. Okay, so for the second year, for the third year, it is 712, and for the fourth year, 3,180. So the total of my present values, Sum total of all these amounts to rupees 10,844. Okay, so now we have the present value which is higher than the initial investment, and we have the present value which is lower than the investment. Okay, one higher, one lower. Now we have to apply a certain formula for this as well. Okay, so based on the previous calculation, it is clear to us that the IRR rate, it falls somewhere between 10% and 12%. Okay, because we have an amount of 11,272 and an amount of 10,844, and 11,000 falls between both of these two percentages. Okay, so you have 10% and 12%. Now generally you'll always start with the lower percentage and then you add more things to it. Okay, you add the remaining parts of it. So based on that, we have derived a formula for this. Okay, so make sure you're writing this comment also. Therefore, the IRR rate must be more than 10% but less than 12%. And the exact rate may be calculated as follows. So this is our formula. IRR is equal to base rate. Base is always the lower figure. Okay, base is always the lower percentage. So base percentage plus difference in calculated present values and required net cash outlay divided by difference in calculated present values into difference in rates. Okay, so basically what this means is base rate, which is my 10%, I'll explain it as I fill up this formula, plus difference in calculated present value and required net cash outlay. Now, the calculated present value that we're going to be taking is going to be the present value of 10%. Okay, present value of 10% is 11,272. So difference is 11,272 and required net cash outlay. So minus net cash outlay is the initial investment, which is 11,000. Okay, divided by difference in calculated present values. Difference in calculated present values means these two values. Okay, these are the only two present values that we've calculated for project A. So the difference between them, it should be 11,272 minus 10,844. And then multiplied with difference in rates. Rates refers to the percentages that we took. So here we took 10% and 12%. So the difference between those two is the last part. So it should be 12% minus 10%. Difference in rates. Okay, so based on this now, we can fill up the remaining portions of it. It's equal to 10 plus, this should be 272 divided by 428 and into 12% minus 10% is 2%. So finally, after all this calculation should be 10 plus 272 divided by 428 is 0.636 into 2, which is basically equal to 11.27%. Okay, so see, it was a good thing, right, that we didn't take 11%. So it's always better that the percentage that you're starting with and the second percentage that you're taking for your trial and error method to be a little bit, should be a little bit of a difference, at least of 2% or even 5%. 5% is also an appropriate difference. Okay, so at least a 2% difference should be there, because in this case, it is 11.27%. Okay, now this is one way of calculating the IRR. Now I'll show you a different method of doing the IRR method. Of course, while I prefer this method, yet again, you can always follow the second method, whichever you're comfortable with or whichever you find it easier. Okay, so IRR can be calculated as by taking the differences between the present values that you've calculated at different percentages and subtracting it with the net cash outlay. Okay, so at 10%, present value is equal, at 10%, present value minus net cash outlay, we're getting positive figure 272. And at 12%, present value minus net cash outlay is equal to rupees negative 156. Okay, so at 10%, present value was 11,272, net cash outlay 11,000. Okay, so this is the difference we're getting. And at 12%, present value was 10,844, net cash outlay was 11,000. So obviously there is a negative figure. Now these two are going to be used to replace in the formula, wherein we're going to take the base rate. I'll write it as base rate plus the difference at difference at 10% divided by difference at the rate of 10% plus 12% into the difference in rates. Difference in rates. So base rate, as we said earlier, we'll take the lower rate, which is 10%, plus difference at the rate of 10% is this amount, 272. So rupees 272 divided by difference at the rate of 10% plus 12%. So 272 plus your negative 156 into difference in rates is 10% and 12%, so 2%. So this should be equal to 10 plus 1.3 is equal to 11.3%. More or less the same, right? 11.3. So this I can also write it as 11.3% instead of 11.27. And these are the two methods of calculating the IRR for the project A. Now, of course, I prefer this method, but if you're comfortable with this method, you can go ahead and use this method as well. Okay, this is a shorter method. In fact, this seems more comfortable. But yeah, again, it depends upon your preferences. I believe this is much easier for me. If you like this one, use this. But make sure you're getting the same answers. That's all. Okay, so try both the methods. Whichever you feel more comfortable with, adopt that particular method. That was with regards to project A, and when it comes to project B, we've already calculated the starting factor, right? We're going to be starting with the factor at the rate of 15%. So let's start with the calculation of NPV, sorry, not NPV, total present values at the rate of 15% for project B. So I've already prepared my table here. Computation of NPV at the rate of 15% discount factor. So again, year 1, 2, 3, 4. 4 years, right? And cash inflows also from the question, you have 1,000, 1,000, 2,000, and 10,000. And present value factor is 1 divided by 1 plus 15%, so 0.15 for the first year to the power of 1. For the second year, 1 divided by 1 plus 0.15 to the power of 2. For the third year, 1 divided by 1 plus 0.15 to the power of 3, and for the fourth year, 1 divided by 1 plus 0.15 to the power of 4. Okay, so you can use the table or you can calculate these, and then it is 0.870, 0.756, 0.658, and 0.572. Okay, again, I'm moving rather fast because we've done this in the net present value calculations. So present value of cash inflows, 1,000 into 0.870 amounts to rupees 870. For the second year, 0.756 into 1,000, it is 756. For the third year, it is 0.658 into 2,000, which is rupees 1,316. And finally, 5,720. So close this. What is our total? Our total should amount to rupees 8,662. This is total present value. It wasn't calculation of net present value. It was just total present value only. Okay. So here, our initial cash inflows or the initial investment that we have made, it is at rupees 10,000. Okay, initial investment for project B is at 10,000, but here this is much lower than 10,000. We have to increase it. In order to increase it, we have to take a smaller percentage. Okay, in order to increase this cash inflow, we have to take a smaller percentage, because a smaller percentage means a higher PV factor. Okay, and just compare the table. Okay, a lower percentage means a higher present value factor. That is why we have to decrease the percentage in order to increase the cash inflows. Okay, so we can write, since present value at the rate of 15% comes to only rupees 8,662. Therefore, a lower rate of discount should be adopted. Okay, should be adopted or should be taken. So in this situation, let us try with a lower percentage. There is quite a big difference, right? 10,000 and this, 2,000 more. So let's start with 10% then. Let's go with 10% straight away. All right. So taking the discounting factor at the rate of 10%. So here we can write on this table, computation of present value at the rate of 10% discount factor. So fill up these areas, first year, second year, third year, fourth year, 1,000, 1,000, 2,000 and 10,000, and present value factors. I'll just fill it up right away, okay? I'm not going to do the calculations. Please make sure you're doing all these, writing down all these calculations by yourself. And 0.826, 0.751, and 0.683. I'll immediately go to these calculations. 909, 826, 1502, and for the last year, 6,830. So if you close this, your total present value, sum of all this should amount to rupees 10,067. Okay, so at the rate of 10%, it is amounting to rupees 10,067. Now, this, the present value comes to rupees 10,000, which is, more or less equal to the initial investment. Just 67 rupees difference, right? So I'll just take this amount at 10%. Okay, of course, you can go for another rate. You can go for 9% once again. But this is already so close to 10%. I can just assume maybe this difference is due to the point difference. Maybe due to the decimal points that we have taken, we've not taken. Okay, we can just assume, we can just attribute this difference of 67 rupees to the present value, the decimal points. Maybe if we'd taken more decimal points, maybe the value would have decreased. Okay, so I'll just assume it to be at the rate of 10% itself and just carry on with the determination of the actual rate of return. Okay, so based on that also, you can just write a small conclusion for this. So we can just write a small conclusion. The present value at the rate of 10% comes to rupees 10,067, which is more or less equal to the initial investment. Hence, the IRR may be taken as 10%. However, if you want it to be more accurate, so for more exactness, the following calculations can be made. So the formula that we applied in the previous project, IRR is equal to base rate plus difference in calculated present value minus your required net cash outlay divided by difference in calculated present values into difference in rates. So base rate, as we said, is the smaller percentage in this situation, 10%. Plus difference in present value minus cash outlay. Present value at the rate of 10% is 10,067 minus cash outlay is rupees 10,000 divided by difference in calculated present values, which is 10,067 minus for 15%, 8,662. 8,662 into the difference is 15% minus 10% is equal to 10% plus calculation. It should be equal to 10.24%. Okay, 10,067 minus 10,067. 10,067 minus 8,662 is 1405 into 5, which is 15 minus 10. So it should be 10.24% accurately. Now, in the question, if you remember, they asked you to compare the two projects and see. Now, in case of the projects that you're having, whenever you have NPV, remember when you're calculating NPVs and there's more than one project, you choose the project with the higher NPV, right? So in this situation also, in case of IRR also, because you're using NPV itself, the base that you're following is again the NPV. So therefore, here also the project with the higher NPV will be selected. Therefore, the project A will be selected or will be chosen as it has higher NPV. Okay, so this is the conclusion you're supposed to write to the question. Okay, so with this, we've also calculated the IRR using comparing two projects as well.